Okay, ladies and gentlemen, what's going on? Jay here, SmartHelping.com. We're going to finish up this accounting system today. I'm going to test every single transaction. We're going to do accrual. We're going to do also every transaction with cash basis. And I'm going to also upload this to Google Sheets today. So a lot of stuff. Before we get started, don't forget to check out SmartHelping.com for more financial models, templates, and tools. You can buy everything I've ever built, which is well over 100 startup models, trackers, all kinds of different things for a bunch of different industries in Excel and Google Sheets, um, valuation tools, cash flow waterfalls. The template I'm working on now will be in the accounting finance tools bundle. So check out that. Remember, any bundle purchase, you get lifetime access to any template that's ever added to that as well. Let's let Twitter know we're live. Let's let Twitter know we're live. Finishing accounting system. Checking every transaction. Cash basis and accrual basis. Okay, let's get into it. So here we are. Let's save this as accrual. We'll also make one for cash basis. And let's start testing out the transactions here. Let me open back up this. So we'll go through, if you were entering transactions as accrual or cash basis. First off, let's just start. Well, no, actually, before we get into that, let's organize this so we have descriptions here. So everything with sales, let's group together, make sure this is all grouped. So sales, sales on account, receipts from sales, contra revenue, deferred revenue, recognized revenue. So let's make these look a little nicer. So we're gonna put these. How do I do? Let's see. We're gonna do this. We're gonna give a space in between each one as well. Revenue transaction triggers. And let's indent these. I want a bigger indent though. 1, 2, 3. Perfect. Okay. So the goal is here, we're going to try to group everything together. What else do we have? And these are actually going to be descriptions. What else do we have that's revenue related? Other income. Put this in here. Now this will allow me to give spaces in between each section, which will help with the drop down. In Google Sheets, it'll be easier because they automatically let you populate as you start typing something in. Proceeds, all of that we don't really want in the top. What else do we have down here? No. We could have dividends. Dividends receivable and receipt of dividends. So that's basically all the income items right at the top. Zoom out a little bit here. Okay. Now we'll do a space, and then we'll have, now it's very important I don't remove any of these transaction items because every single one of these items is tied to logic. Now we can remove this here because we just added it up top. All right, next up, we'll just go right on with cost of goods sold and inventory. That's a good group. And let's make a space. What else? So G&A, all these are OpEx items. So here's, let's see, this is revenue. This is cost of goods sold, inventory. Then we're going to have OpEx. And note for cash basis, the nice thing here is on the OpEx, you can hit the expense entry. And then if it's on account, you can enter that here and then enter when it's received on account. So there's basically 3-tier. That's how we can do cash basis or this. Or, I mean, accrual doesn't necessarily mean it has to be on account. It just means you have to recognize the revenue and expenses when they're earned or used. So if you have an expense in the same month that is used, you could just enter both of these in the same month, or you could use this. It's either way. It's just a matching principle. Okay, so OpEx, this is good. What else do we want under OpEx? Just making sure. Oh, other expense. Now this, I believe, is just kind of on its. No, this is actually not going to be an OpEx. This is a other expense. It's like a non-operating expense, like an ordinary expense. Dividends. Nope, nope, none of this stuff. Now, prepaid expenses. And bad debt, allowance for doubtful accounts. But technically, bad debt expense is going to be an inventory item because that's entered every time inventory is entered. I mean, not inventory, every time accounts receivable is entered. If your business regularly has uncollectibles, then you have to estimate that every time you enter a receivable. So let's put these bad debt, doubtful account recovery. Yeah, all this stuff can go in revenue. We need more space actually. Okay. All right, that's fine. Cost of goods sold. This now OpEx, and then yeah, we want the prepaid stuff in here. So we want prepaid expense. Wait, so all this we just moved up here. Bad debt all the way to recovery of doubtful accounts. This is up there. Now prepaid expense account, and that's going to flow right to here. Other expenses, and these are prepaid items. So we'll put those in OpEx as well. I'll do the labeling on this when we start going through the actual entries in the system itself. Okay, revenue, cost of goods sold, operating expenses. What's next? We have, what would be a next good category? Capital items, I guess. So let's call this uh, capital purchases, depreciation. So this is the depreciation expense obviously sits there, accumulated depreciation, capital asset purchase, payment. Okay, those are all fine and they're already in a good category. Let's keep moving down here. Now we have taxes. And there's a couple things here. We've got income tax, tax liability, tax payable, deferred tax liability, payment of income tax. Oh, I forgot to move this. Actually, this note needs to stay with, let's see, that's with, I believe this, the proceeds entry is to record. Actually, we'll don't even need that. We're going to go through each one individually anyway. All right, so taxes. Any other? We do have sales tax payable. Where's this at? Right here. Now, the reason why I want to organize this is so if somebody buys this and starts using it, they'll be able to see the categories and it'll be easier to navigate the drop down as well as to look up different account types and how to enter various types of transactions. Oh, and yeah, might as well not even have the cash basis because that's going to be the same. I don't want to redo work. So we'll do the accrual first. Okay, sales tax, any other tax items here? Just put those up there. Sales tax, payment of sales tax. Next, we have loans, debt, payments. So receiving a loan, paying principal back, interest. Now, interest expense is if it was cash basis. In this case, you just enter both these at the same time because this is automatically tied um, to an accrual account. But you can just enter it whenever you pay the interest expense. You don't have to accrue it. Okay, what else do we have? So loans, debt. So gain loss on sale applies to a couple different areas. We're going to put that down on its own. Sale of capital assets, that needs to go up here. Actually, we have a couple up here. Sale of capital assets and proceeds from sale of capital assets. Oh, I know what we want to do next. Let's do stock, issuance, and dividends. So here, common stock, additional paid in capital. And then we have short term is all of these items. Short-term investments in securities or stocks or what have you. And then long-term, I added this last night, so you can have long and short-term on the balance sheet. I also added, what else did I do last night? I did that, and then, other income receivable for dividends. Dividends receivable. Which is our last entry, it looks like. Well, wait. Common stock. Let's keep these separate. So stock, hold on. Yeah, wait, I didn't mean to combine these. So this is separate. And where'd we put other expenses? This other income is non-operating income. I guess we can keep it there for now. Other expense. We'll put it up here. Okay, there, taxes, debt, stock issuance, dividends. And then we'll have short and long-term security holdings, purchases, sales. Now, this gain or loss on sale here is going to apply to a whole bunch of stuff, so I want to put it on its own. And we'll put a note on that because it's going to affect a couple different accounts. Okay, so we are now organized. If we look at our drop down, it has the same organization now, and you can see it's got a space in between each section. So there's all the sales account items, then cost of goods sold, inventory, G&A, depreciation, all that stuff, income tax. So there's a space in between which kind of helps you browse the sections. All right, well, let's get into it now. So now that we have these labeled, we can go ahead and do the cash basis one. Don't want to redo work, so we'll overwrite that. Also pull back up the accrual. And let's jump into this now. Really excited to get this thing checked and working. All right, so first entry, let's just go right down the line. We have sales. And we'll put made sales in period 5,000. Now this is actually going to be the same for the cash basis. And all it's saying is we've collected sales in the whatever period it was entered, not on account or anything like that. Look at the quarterly, make sure that is matching up. Annual balance sheet, we basically just got cash, so there's that. Retained earnings, looking good. Cash flow statement, we just have net income of 5,000. All good. Okay, now we put notes. So what this means is used to record sales in a given period. This is not on account, and if but sales collected in the period earned, if cash basis, this is used whenever cash is collected in a period from customers. Because remember, cash basis has no accounts receivable or payables. It's just whenever you pay it, it goes as an expense for whenever you pay it out, and whenever you receive sales, it's not on account. Okay, so we can actually copy that for the cash basis description. Let me clear these out so we don't get confused. All right, one item down, lots to go. Let's go back to the accrual basis. So we made sales. Next account, sales on account, and this will require a couple different entries. So you've got the sales on account when the sale is made, and then you've got whenever you received it. So let's say we received, made sales on account. Let's say we made $50,000, and then let's say in February received some of the sales that were made on account. Let's say you received half, 25,000. Now that's going to be for cash basis, it's not relevant, so you won't have it. Not relevant, not relevant. On the accrual side, you've got cash sales going up by 50,000. You're recognizing that revenue in the period it was made, even though you're not getting all the cash. On the balance sheet, you can see here we've got a receivable now of 50,000, and when we receive the rest, that goes down to 25,000. Cash goes up, and this is all working just fine. Here's the quarterly balance sheet, annual. Perfect. Now cash flow, you can see here we made 55,000 in net income. We had to reduce the amount made on account. Then we increase whenever we receive those sales over time. So there's that happening, and there's the actual cash flow happening each period. Quarterly, annual, looking good. Okay. Next item we have is we have Contra Revenue. So this could be both accrual or, and let's put this in January, or cash basis. This is saying had a refund, discount, something that reduced sale. No, that's too broad. Would we refunds? I don't know why I put receipts in here. This doesn't make sense. Refunds, discount. Oh, returns is the other thing. Let's update that wording. And cash basis, same deal. You can have those as well. Now, on cash basis, the refund just happens whenever you have to pay the money back. I'm trying to think, I guess if you were doing this on accrual, like in this case, we have a refund. It would have to be a refund of money that's already been collected. So it's not like we were doing anything with receivables. Let's say there was a $500 refund. So that hits income statement as a -5. Perfect. Goes through. Balance sheet, all that's happening is we're reducing $500 of cash. So there's that happening right there from 5,000 to 4,500. And cash flow statement is accounting for that here in net income. Net amount 4,500 here instead of 5,000. So that all is flowing good. Contra revenue, oh yeah, and then cash basis, same deal. Refund or return, refund, discount. So we put that in as a contra revenue item. We'll just do 500 here. So for this, again, it's just going to show you that 500 coming out. Looks good. Oh, I forgot. We need to do our definitions here as well. So sales on account for accrual basis, and this is recorded when a sale is made and invoice is sent to customer. It will go down when receipts from sales on account is recorded. Okay. And then this is to record money received from sales made on account. Pretty simple. Contra revenue. Transaction item to reduce revenue. This is often things like refunds, returns. Now, actually, not a return. We don't have, shoot, we actually didn't do a journal entry to account for returns, where your inventory would have to actually go up. So we might need to add, I'm trying to think about, I mean, that's going to be relevant for a lot of cases. What do we say here? Refunds, discounts. Yeah, so we might have to add that at the end. Let's think about this. If we had to do a return really quick, it would you would increase the cost of goods sold by however much it was applied to that item, or it would be a negative cost of goods sold, which would increase inventory by the same amount, and then cash would go down. All right, so not too hard. I'll add that at the end or later, but that's possible. Now for cash basis, it wouldn't matter. You're not, well, no, you could have inventory tracking. Yeah, so it would. All right, so we'll figure that out. Next item, deferred revenue. So that's not going to have anything to do with cash basis. It will be an accrual. So deferred revenue, let's say we, in February, collected, this would be collected cash for sales services that will be provided in the future. So this is going to be like your enterprise SaaS or other different contract work. Let's say you collect, where is it? Deferred revenue. Let's say you collected $25,000 in February. Now on the income statement, you can see this is actually not entering anywhere. On the balance sheet, it is a liability. So this is saying you have to provide $25,000 worth of services. You haven't yet. So that's a liability. On the cash flow statement, it is added as a cash influx. So you're getting that 25,000. So on the balance sheet, cash is going up and liabilities are going up. Now, when you provide that over time, let's say now in March, you provide all of services paid for ahead of time. Now you have to recognize some of that. So deferred revenue is now, we're saying recognized revenue is the account we're going to use. Let's say you did 7,000. Okay, so now watch what happens. Income statement, we recognize on accrual basis when the services are provided, we recognize the revenue. So that's the matching principle. So there's that 7,000 coming in. And that's part of 62 because we already had 55. Balance sheet, we're now decreasing the unearned revenue liability down from 25 to 18. Cash is going up. Retained earnings is going up. So here, no, or cash is not going up. Cash is not moving. And you can see here on the cash flow, when we recognize revenue, we reduce it because we already added the full amount when we added deferred. But it is in net income. So to not double count it, we have to reduce that out. So there's no cash effect happening here. All that's happening when we collect that or recognize that revenue is retained earnings is going up, liabilities is going down. And remember, assets always equal liabilities plus owner's equity. So that balances. Okay. So that's good. Let's describe that. So deferred revenue and recognized revenue. When cash is collected for goods or services that are not provided until a later date. Used to recognize when unearned revenue becomes earned. no cash effect. And again, for cash basis, this is not relevant. Okay, next up, other income. So other income, let's say in January, we had received an item that received income that is not part of normal operations. Now this could be like an insurance claim, this could be, dividend income, whatever, and it's not on account. So it's just saying you received some income from something. It will increase income here, increase net income. It will also increase cash. Now this also flows to other comprehensive income, not retained earnings. So this 2,500 here, it does hit owner's equity on the balance sheet, but it hits other comprehensive income accumulated, not retained earnings. And then cash flow, it will hit in net income. And it is cash received whenever that happens. Now cash basis, same deal. So let's say in February, received income not part of normal operations. That goes into there, hits the cash right there. There's part of net income. And it goes to accumulated other comprehensive income. But it's just to show if you're trying to analyze this income statement, you want to know like that's not part of regular operations. So it's not part of EBITDA or net operating income. All right, that was a simple one. Next up, wait, let's put that here. So used to show cash received from activity that is not part of normal operations, i.e. insurance, claims, rent, income, or what have you. Okay, now let's do dividends receivable. So dividends receivable, we'll put this into March. Dividends declared from companies you own stock in. So when that dividend is declared, you automatically have a receivable. Let's say it was for, I don't know, $1,200. So this is going to increase. It's not going to do anything with on the income statement yet. It will increase an asset here, dividends or other receivables. And cash flow, it's getting reduced out. Wait a second. Oh, and it is hitting other income on the income statement as well. So it's not part of normal operations, but it is increasing, the income you have. So we'll reduce it out. Now, when you go to receive it, let's say in April, you then receive that dividend income or whenever, some point in the future. Received income from dividends that had been declared. And we just put receipt of dividends, and let's say we got the full 1200. Now keep in mind, I'll show you on a cash basis. So here, income statement is not affected. Balance sheet, we now no longer have the asset, but we have the cash that's gone up, and cash flow has gone up here, add dividends receivable. On the cash basis, what we would do is either you could record it as other income, or you can put, if you want to have it separated out into dividends, let's say in March, you would just put both entries in the same month. Dividends received. And you would just use both entries to show it happening at the same time. So dividends receivable, receive dividends, and whatever the amount is. I'm prioritizing the accrual basis here. So on the cash basis, you can still account for this separately if you don't want to put it into other income, but you just have to enter both the entries in the same period whenever you do receive that. Uh, so in that case, you have the same effect of like a cash flow where it's hitting income, you're reducing it out, but you're also adding it back as received. So net net, you received 1,200 cash in that period. Income statement, it just hits there in other income. And balance sheet, you don't have any receivables or payables. It's cash basis, but you do have a change to the other comprehensive income and cash. Now for the accrual, we have a little bit different. So this is recorded when a dividend is declared for companies you own stock in. Recorded when you receive dividends that have already been declared. All right. Revenue is the biggest account. All right, what else do we have? So receipt of dividends. Bad debt expense. So this is a real tricky one. Let's do this in May. So actually, no. So for this, we have to do it matching if this is GAAP, US GAAP, we have to say when these sales were made on account in January, we would have to also put some amount are recorded in recording bad debt expense in periods sales were made on account. So here you can just put bad debt expense. Let's say these $50,000, we think, $500 is not going to, we think 500 is not going to be collected. That is going to then accrue to allowance for doubtful accounts as a contra asset. On the income statement, it's recorded as an expense, bad debt expense, in that same period that the revenue was recognized, or rather not the revenue recognized, but the sale was made and the revenue's hitting the income statement. Or actually, yeah, that is when revenue is recognized, not when the actual cash is received. And then, so this is a bucket, allowance for doubtful accounts. We also have, let's say we want to write some of that off. We could say maybe in March, customer said they went bankrupt and will never pay. Now, if that happens, you simply say, I did an entry here called writing off doubtful accounts. Let's say that was $200 worth of those sales. So now on the income statement, we have no entry, and that's where write-offs actually don't happen here, only when you record the bad debt expense. But the balance sheet, we reduce the available doubtful account amount. So now it goes from 500 to 300. And I believe that's it. We added back this. And all it happens is that's just kind of a running fund. Now you could say, what if in May, what if you received some of the funds that had been written off? So you've written it off, but now you want to say, well, we actually collected some of it. You can say recovery of doubtful account. Let's say you recovered 150 of it instead of 200. So now, again, income statement's not going to be touched. Balance sheet goes up by the amount you received in doubtful accounts, and cash is going up by the 150. So you still balance here, and you can see on the cash flow statement, nothing happened here because we made sales on account. We added back the bad debt expense, but we actually then collected some of that here. So collection of bad debt, so increases cash and increases the contra asset, increases cash here. So this is the same, and we're not touching anything with retained earnings or accumulated other comprehensive income, because all that essentially is already being accounted for when we initially do the bad debt expense. And so that's why it's like a disconnected kind of accrued fund, where you record that expense here right when the sales are made on account, and then you have this bucket that you can pull from over time. So it's very interesting. All coded here works great. So you can record it, you can write it off. You can also add it back after it's been written off with these entries. Let's see. So a cash basis is not going to have any of this stuff whatsoever. You just either receive it or you don't. So this is not relevant. We don't care about any of that. All right. What else do we have for income? Oh, let's actually write this. So recorded when sales are made on account if you regularly don't collect a portion of receivables. This is an estimate you have to make yourself. Any available information you have. So this is to allowance for doubtful accounts. I don't actually think we need, no, because bad debt expense automatically affects it, and then writing off. We actually don't need this entry here, so we can delete this. because if you look at allowance for doubtful accounts, we just add the bad debt expense, writing off doubtful accounts, and recovery. We don't actually have an item to just directly affect allowance for doubtful accounts. It's going to be affected by bad debt expense increases it, this decreases it, and then this increases it again. And I don't know if I showed that before, so you can see, oh yeah, I did. So you can see here it's going down with the write-off, and then when you receive that back, it goes up because now you're saying you recovered that, so it's no longer a doubtful account. So whatever was in here should be more for what you might use in the future. Cash basis, yeah, no point in having this here. We only want items that were actually going to affect logic in this area. Okay, so far so good. Everything's balanced through revenue. We've now hit every item. So this is used when you decide a given account is not recoverable, used to add back funds that were received from accounts that had been written off previously. All right, well, we got through all the revenue, and it took and organized this, which took 50 minutes. Whew, this is intense. This is intense. I'm going to try to keep going here. I'm just looking at something real quick. Okay. What's next then? We have, I mean, I'll tell you what, this is intense work. I would take suggestions. What do you guys think this thing's worth if you feel like commenting? I was thinking $99. I mean, honestly, there's so much value here for so many different users. It's insane. All right, so accrual. Let's look at cost of goods sold, non-inventory, and we can go back to January if we want, or let's just do February. And recording expense, recording cost of goods sold expense that is not inventory related. So let's say it's a SaaS company, this would be like your Amazon Web Services spend. It's a cost of goods sold, non-inventory. Let's say it's 3,000. Now we're not saying this in this case, it's not on account. It's just an expense. We're saying it was recognized in February. We used it in February. We got the bill in February. It all happened in 1 month. So cash goes down. Retained earnings goes down, so that balances, and the cash flow statement, you can see it happening in net income, and there's no other effects. So that's fine. Used to record when an expense is incurred in the same month it is paid out of the bank for cost of goods sold items not including inventory. Now, if it's an item that's on account and it's cost of goods sold, you're going to have to put it in G&A, S&M, or R&D, or as essentially a liability that you're going to have to pay. You'll have to use these two accounts, like G&A on account and then received on account. So we're not doing cost of goods sold with an account. Now this is the same for cash basis. You put that in here. And yep, so non-inventory balance, perfect. So that's fine. Now let's do in February again. Let's say we have, what's our next item? Cost of goods sold, non-inventory. Oh, I do have it on account. All right, forget everything I just said about it not being on account. So yes, you can recording cost of goods sold expense that is not inventory and owed in the future. So now let's say it's 2,500 here. This is saying your liabilities are going up. Cost of goods sold payables going up. Uh, cash is not affected. So we're adding back the non-inventory paid on account. So zero effect there. You're recognizing that expense in this month. And let's say you got an invoice that's due next month, you would recognize it in the month it's for. And then let's say in March, we paid cost of goods sold that was non-inventory and on account. So then you go payments for cost of goods sold, non-inventory. Let's say you did the whole thing. Income statement's not affected. We already recorded the full cost here. Balance sheet, we are reducing the payable, reducing cash, and then you can see on the cash flow statement, there's where that payment comes in for this that was made on account. So that works fine. Cash basis, not relevant. Anything on account is not relevant. Now for this, it is, so we want to say cost of goods sold, non-inventory on account, used to record when a cost of goods sold expense is incurred on account and paid at some future date. Used to record when a cost of goods sold expense is paid that was previously incurred on account. Non-inventory. Okay. So that's good. We're moving on down the line. We're balancing everything, which is great. Everything's working as it needs to be. All right. Man, I'll tell you what, this is tough. This is tough work. Okay, what's next? So we've done this. Let's get into inventory. Let's say in April, we paid for inventory. Okay, so inventory purchases. Now in this, we're paying for inventory not on account. So it's like you just sent them $3,000 for inventory received. Now with accrual basis, you could have it on account or not. It depends on if it's on account. Inventory, it will hit not anything on the income statement yet. When it will hit is when we define cost of goods sold for inventory items, which is after this, but this doesn't necessarily have to be in order um, for me to check it. So inventory purchases 2000, that increases the value of inventory, which is right here. So you can see in April that goes up, cash goes down. That's the only accounts affected. You see on the cash flow statement, here's our inventory cash going out. And net effect negative 2000 for that month for that item. Used to record inventory purchased not on account. And then the next one, used to record inventory purchased on account. Used to record when inventory that was purchased on account is paid for. And we'll get into the cost of goods sold inventory. That'll be the last item we'll get into in this whole tranche of stuff. Now, cash basis, we use to record the purchase of inventory when that money goes out. NNA, NA here. So for accrual, we could say in April we also bought inventory on account. So maybe you paid for some up front, which could be this, and then you paid for some on account, which could be this. Okay, now that 5,000 again does not hit the income statement anywhere. It hits the balance sheet and it will reduce cash in the period. It also increases inventory payable in the period, and here's the cash flow effect. Where is it? 5,000 in April. Oh, on account, it's not a. So purchase on account, it actually doesn't get hit in income or doesn't have to be reversed out because it's not in net income. Only when we paid it directly. So all that's happening, let's see, inventory is going up here and then the liability is going up. So it's just affecting the balance sheet. Here it's going up and this is going up, these two. That's all that's happening. Now let's say in May, paying for inventory bought on account. We just go to the next thing down and we say payments for inventory on account. Let's say we paid it all, or maybe 4,000 of it. So again, that's not an income statement item. Balance sheet though, it reduces the payable. Cash goes down. here on the cash flow, you can see this is when we're reducing that payment made. So cash goes down, liability goes down. Now let's say we actually whenever we sold the stuff, let's say in June, sold inventory. Well, if you sold it, you have to say what it cost. So we put cost of goods sold inventory, and this is that cost. And let's say you sold everything you've bought in so far. So your cost of goods sold is going to be, even if you haven't paid for it yet, so it would be 5, 6, 7,000 worth. Now that is when you hit income statement. And note the sales you'd have probably a sales entry here to record the sales happening. And those could be on account or not, but it's a separate journal entry on here. So we say cost of goods sold, that hits here as a negative. Cash flow is not affected because remember, we're just reducing inventory. We've already paid for it, so it's a non-cash item. Balance sheet, we still are saying we owe, but look at this. Inventory is now going back to 0 because we've sold all our inventory we've purchased. So inventory asset goes down. Net income goes down, which is going to reduce this retained earnings. So there's the offset of assets and equity. We're still balanced here. Everything's balanced. Assets equal liability plus owner's equity after all these transactions. So that's great. Yeah, so good. This works. Now, in cash basis, we do have, so record what when inventory is sold, the value. So all we had here was, yeah, you buy inventory. Whenever you pay for it, that increases the value of your inventory, and then whenever you sell it, it goes down. And we could put that here, let's say in March. So much simpler on the cash side. Record when inventory is sold. Oh, and we also have to put record when inventory is purchased. So here we can say inventory purchases, not on account, say 6,000. Let's say we sell 5,000 of it here. So on cash basis, income statement's getting hit with the inventory purchases here, or the cost of goods sold. The balance sheet is inventory is 1,000 because we bought 5 or 6 and sold 5. Now if we sold this in like a couple months, you can see the balance sheet will have inventory until May, then it goes down. Now when this goes down, we're also recognizing the expense, so retained earnings goes down. And then the cash received for that would be some sales entry that we haven't entered, but that'd be the other side of that. Obviously, you make when you sell something, you make for some amount of money. Cash flow, again, this is zeroed out because it's an inventory item. So no cash effect, even though we are recognizing the cost of goods sold as an expense on the income statement. The actual inventory purchased here is where we record the cash flow effect. So that looks good. Did I write that? Yeah, I wrote that in here. All right, well, we finished the first 2 sections. That's pretty great. Where is accrual basis? Let's put this in here. LIFO, FIFO. And we're not going to get into that. It doesn't matter. Whatever you use to value the inventory that's sold, you would use that and record it when it's sold. All right. So we've covered everything that has to do with revenue and cost of goods sold and inventory. So far, no hiccups. Everything is balanced out. That's good to know. We've got the transaction items all organized and labeled, and now we've been describing all these. And boy, I'm exhausted. So how many did we get through here? 12, 19, and we've got how much left? Holy moly, we got 42 left. If I did 10 more, that'd be halfway. Let me check here, make sure this. Let's put NAs on everything that's not relevant. So here, there's nothing on account. There's no prepaid expenses. Depreciation is irrelevant. Capital asset purchases are relevant, not on account though. Now for this, I don't think, so cash basis, I don't think you're worried about deferred tax liabilities or sales tax payable. No, but you'll just put, this is one of those where you'd put sales tax payable and the sales tax in the same period. Deferred tax liability, uh, let's think about that. I guess, so for cash basis, you just record when you send the money out. That's your income tax expense. So we'll have to look exactly at how that's going to work with cash basis. That's relevant. That's fine. I actually am not sure about cash basis accounting for like long-term stock holdings because I don't see how else you would do it besides this. So in this case, I guess you would just use anytime the event happens, you just use all these accounts and we'll go through that whenever we get to it. So that's fine. Obviously, accrual is going to use everything here. And yeah, I mean, I'm not going to rush. I'm exhausted, so we're going to just keep doing this tomorrow. And we'll get through some more. Now, I don't have to do any organizing of these, so that'll be a little bit quicker. Hopefully, we can get through, let's see, we did 19 today, maybe 30 tomorrow. That's 49, and then we'll have, how much is left after that? 61, a couple left. But yeah, I've had it for today, and I don't want to just force it. We want to make sure the checks are good and these descriptions are good, because whenever someone buys this, they're going to have to look at all this. and make it make sense to them. So we want to make sure our descriptions are good and everything's going. So we'll keep on it.